Hello and welcome to another weekly financial update from RTS TV. I'm your host, Carl Roberts, Chartered Financial Planner at RTS Financial Planning. Hope you're all doing well, safe. I think it's starting to feel a bit more normal now. Things are starting to get a bit back to some sort of normality with the weather helping and being able to go outside a bit more. So that's all good for the mind. So last week I spoke about the huge costs the government is facing to support jobs through the recent pandemic, and every week we find out a little bit more. So the UK's net debt at the end of April stood at 98% of GDP. So what this means, this is equivalent to us doubling our entire economic output for a year just to be able to pay off that debt and pay for everything we normally would. So it's a staggering amount, really. The actual debt that's been accumulated over the past month is equivalent to 8 years worth of deficit reduction wiped out in the space of a few weeks. So who remembers those David Cameron years and all that austerity? Was it really worth it in the end? In more government finance news, VAT receipts, this is interesting, VAT receipts were actually negative last month as the government refunded £900 million more than it took in. In terms of property prices, this week we saw Aviva, one of the largest insurers in the UK and real estate managers, they've warned that property prices could fall 12% as a result of the rise in unemployment. Retail and airline stocks, though, had a good week. The UK government announced that all non-essential shops could open from mid-June, so this was good news for retail stock prices. And in terms of airlines, there was quite a bit of good news for airlines this week, actually. The German government announced a $10 billion bailout package for its biggest airline, Lufthansa, which should rescue that company from bankruptcy. As it was only operating at 1% normal capacity, it was actually losing $1 million per hour. France and the Netherlands have also agreed a $12 billion bailout for Air France KLM. And more good news for airlines came by the way of announcements. The German government announced that flights could resume from June, and Spain agreed that all flights could resume from July, so hoping to boost their sort of tourism industry. So we saw airline stocks rise sharply. TUI shares were up over 50%, and IAG, the owner of British Airways, were up 22%. Now, this is all a reminder of just how difficult it can be investing in individual shares. Before the pandemic, investing in large airlines would have been seen as a pretty comfortable, safe bet with minimal risk to their business model. But as the pandemic started and flights were grounded, airline stocks were completely smashed to pieces. And if you'd sold out at the bottom, like obviously many people have, you're probably going to be pretty annoyed now that the airline stocks have risen so strongly. As things get back to normal. Over in Asia, you may remember pre-2020, a lot of news time was devoted to protests in Hong Kong over a new Chinese extradition law. Well, China seems to be coming back again now with a new security law they plan to implement in Hong Kong. And it looks like the protests are starting up all over again. The US are not taking this news very well. If you remember, the US are already unhappy with China about their handling of COVID-19 and their response. And the US has now passed a bill that could ban all Chinese companies listing on US stock exchanges and delisting existing ones, which is really going to mess up investors' US stock portfolios. This is big news for China as well, though, because Chinese companies can get a lot of new investment by listing in the US. On the other hand, though, it has been good news if you are an investor in the US stock market, as the US stock market recovery has been quite something, really. They've nearly recouped all their COVID-19 losses. But a word of caution, though, all is not as it seems. The main driver of this recovery has really been 6 individual stocks, the so-called FANG stocks, that's Facebook, Amazon, Apple, Netflix, Google, and Microsoft. They account for around 20% of the US stock market, and they've really driven this recovery. The rest of the stock market is not as rosy as it appears. So again, another reminder that individual stock picking is hard and should only be reserved for a small part of your overall portfolio, the part you're prepared to take significant risk with and see significant losses. So I hope that's useful. That's all you need to know for now. If you have any questions, do pop them in the comments section. I'll happily go through them and answer them. But until next time, stay safe, stay well, take care, speak soon.